Hey, how's it going? So this is gonna be a big rant. YouTubers are being useless again, right? So leverage funds tell you that for every one stock you buy, right? So that's what they tell you. That's what it works. Like, you buy one stock and you get 2 on a loan, right? So what happens is you buy one, and then the leverage company goes and buys 2 by using debt. This is incorrect. I will tell you straight away. This is wrong, completely incorrect. So I'll get to that in a sec, but I'll link this in the description, but you will see that it's completely wrong because it's a synthetic replication. I repeat, do not hold any assets whatsoever. So nobody goes and buys anything. What they're doing is participating in swaps. Right? So we're gonna get into this in a minute. But like, look, the entire YouTube is filled with complete dog shit information. And I clicked on, you see, like I clicked on those videos. I watched all of those videos. Look, this guy literally draws a graph to tell you that somebody somewhere borrows money to buy 2 extra shares for you and add them to your portfolio. So I was like, okay, wait a minute. If you do the maths, and they charge you 0.75% management fee, right? Because if you look at their, let's just do QQQ3. QQQ3 management fee, right? 0.75%. So what they were telling me is that they charge you 0.75% to go and borrow 2 times the amount that you are buying on a loan that is 5%. Mathematically, it makes no sense. The loan interest on this transaction will destroy all of their profits. It just mathematically makes no sense to me, right? So I analyzed, I did the maths. I'm not going to get heavy into the maths. On loan interest alone, they cannot break even on costs even after 2 years. And I went with 2% loan interest. That is impossible. Interest rates right now are 45%. So even on 2% interest, which is impossible, they still can't break even on 2 years, right? On loan interest alone, you have to factor in other costs like capital gains, overhead, salaries, electricity. I mean, look at the salary of Wisdom Tree CEO. This guy here, look, 5.4 million in salary, right? This guy here. Look, you see? Like, that's shitloads of money, right? So that will cut in to their costs because that's a very heavy salary, right? So how are they doing this, right? So all of this is completely incorrect. So I was like, okay, let me read the brochures. Let me read the fine print. So I went into the fine print, and here is what I found: synthetic replication. When I see this word, I just start pulling my hair, because what that means they do not physically hold any asset. Look, it even says here, they do not hold any assets at all, right? You see? So, look, synthetic ETPs, which is exchange-traded products, involve creditors to return swap counterparty, which theoretically could default on its obligation under swap. Okay? So they're saying they can theoretically not pay you at some point in time. right? So that's a big red flag. That's red flag number one. To minimize the default, synthetic ETPs generally, okay? Now, listen to the keyword, generally, not always. That means they potentially could have no collateral. That means if the swapper defaults on its obligation, they're gonna tell you, we're sorry, but you're not gonna get your money at all. Generally backed by collateral, which are assets under swapped counterparty, provide security on its obligation under swap. ETP typically strict collateral policy. Typically, again, read the word typically, right? Typically, which means not always. Again, which means that there could be nothing there. In event counterparty default, ETP should be able to sell the collateral. Again, read the keyword should be, which means not always, and then pass on proceeds to the sale to the investor. So do you see what I'm saying? Imagine you come in and you'd be like, hey, a guy comes into you and he says, I'd like to borrow a loan from you, and you'll be like, well, do you have any money? Well, I should be able to get enough from my salary, and I, in theory, should be able to pay the loan. And what else do they use? And generally speaking, I have paid it previously. Do you understand? Like the language is just very, very weak. It doesn't give me confidence, right? So synthetic replication means they do not hold any assets. You just have to remember this. When you are dealing with ETFs, index funds, you have to ask very, very important question. Do they have physical exposure? All right? Remember this keyword, physical exposure. Physical exposure means, look, I'm going to link this in the description below. If you go to, let's say, something like Vanguard S&P, look, fund objective, the fund managers passively manage or indexing investment approach through physical acquisition of securities, right? So you actually hold the assets, you hold the securities. Whereas in here, you are holding jack shit. All you're holding is a swap, which means somebody somewhere is going to promise to pay you if they are right or wrong. Now, I'm going to get to swaps in a second, but I just want to nail it home. Nail it home. You do not hold any assets when you are in a leverage fund. You have to understand, you do not hold any assets. If the swap providers will fail on their obligation, there is nothing for you to sell. There is no Apple stock, there is no Microsoft, there is no Amazon, there is nothing for you to sell, right? So you have to understand how risky this shit is, right? Right, so 2 points. Number one, leverage funds do not hold any assets whatsoever. All they're holding is a swap. Number two, once again, you should never listen to a YouTuber talking about finance, giving you advice on finance, because all of these guys, you have to remember, they are high school, college dropouts, right? They are not intelligent. They have literally no brains. They're making money by telling high school kids that their investment advice is good. I made a video on this guy, Stock Mo, or whatever, what's his name? Stock Mo, I think, right? One of my previous videos, right? Well, I have him banned, this guy here, right? I specifically made the video analyzing his stock advice, and his net was minus 70% over 2-year period, right? So he is losing at least 70% per year if you follow his advice. Do you understand? It's disgusting shit. I don't understand how this is legal. All right, so I vetted, venting, I think it's called, right? So, all right. So now let's talk about swaps. What is a swap? Right? So in layman terms, I explained it. I'll link it in the description below. Now, if you want to see a good explanation, I'm gonna link this in the description below as well. If you watch the movie Big Short, there is this scene here. Do you remember in the casino? He was talking to this CDO seller, right? And it's on 3 minutes. It's in here. I'm gonna link in the description. But they explain what a swap is. Swap is basically it's like gambling bet, essentially, right? So, essentially, I don't know how to explain it. It might get too difficult. I'm just trying to figure out how to explain it in like super layman terms. Like, if you think about the market, there are two types of people on the market. There are the bulls and the bears, right? So we can say bulls think that market will go up. So they are positive outlook, right? Now bears are the opposite. They think it will go down. Now, because two parties exist on the market, it becomes possible to create swaps and bets. Because you can, for example, right, a bull, which is in this video here, what's his name? Some fund manager, basically. He came over to the banks and he started betting against the mortgage market. That is bull behavior because he thinks it's gonna go down. Okay? So bull, which is negative guy who thinks it's gonna go down, approaches a bear, right? This is the contract. Approaches a bear and says, "Hey, I will give you €100 today, 100 euro today. And I'm betting that in 1 year time the stock market is gonna be lower than it is today. And if I'm true, you will give me 150 euro." Now, numbers can be anything. This can be 10 euro, this can be, I don't know, this can be like 40 euro. 1 to 4, 1 to 20. You will, if you watch the movie, it's actually pretty good. You'll see that there's like 1 to 20, which means that this will be 100 multiplied by 20 is gonna be what, 2000? Yeah, so this will be 2000. So he's saying, but let's stick with 150 euro. He's saying that if I'm right, you give me 150 in 1 year time. Now, bulls, because of their nature, they think, okay, betting against the market is a bad idea. I'm gonna take this bet because I think I'm right. Do you understand? And as a result, a market exists for the swaps. These are the swaps. So you can think about it as a contract where bull gets, the guy who's positive gets 100 euro today, and then if he is right, he gets to keep 100 euro for free, essentially, right? But if he is wrong, he has to pay 150 euro. Now, remember how to say, risky that is, because this guy, if he's wrong, potentially could not even have 150 euro to pay the bull, the bear, the positive guy. So there is risk on this side. Does that make sense? I hope it makes sense, right? So basically this only works, this whole leverage fund only works as long as there is enough bets. Well, basically it only works as long as the market, as long as the fund manager is guessing correctly. Does that make sense? Like, as long as the fund manager is right, this works. If enough of the bears, which are negative guys, are right, i.e. the fund manager is wrong, all of your money disappears, right? Because remember, this is a synthetic replication. In the movie, it's exactly the same. They are called synthetic CDOs, right? Whereas this thing is exactly the same, only it's synthetic ETP. Other than that, there is no difference, right? So I'm just saying that this, to me, this is a, basically, don't do it, basically. Don't do it, and that's it. If you want proper funds, always ask, is it regulated? Does it have physical exposure, which is physical acquisition? So you see, I always talk about S&P because it's a very good fund. You can also do Vanguard WORLD fund. Vanguard WORLD fund. This one here. Let's look at this one. Yeah, you see? They all have physical acquisition of securities. Another one I like is Nasdaq, which is a technology fund, right? Again, you see, if you look at this one, they have physical replication. Physical replication. Remember this replication method, physical. Do you see? Always look out for this word. If they say synthetic, that means they're using swaps. Now, swaps have a lot of different names. Swaps can be called derivative. Swap can be called a put. Swap can be called an option. Swap can be called a swap, right? So remember these words. Remember the words, right? Swap, alternative names. Option, put. Most of the time it's called derivative, to be honest with you. Derivative. Put or a swap. Now, when you see these words, or synthetic replication, synthetic ETP, for example, or CDO, or bond, or anything synthetic, will tell you that they don't actually hold the asset. All right? So when you see those words, I would advise you, unless you are like financial professional, you've been doing this all your life, like I'm talking, you have experience, I would advise you to stay away from this, because you don't know what you're doing. Does that make sense? You're basically like, there is no, like again, listen, please listen to the words they're using. Issue do not directly hold the assets, right? Generally backed by collateral. Do you know, like these red flags are just firing. Could default on its obligation. So I'm just telling you, this is disgusting bullshit. And do not listen to YouTubers who tell you that they know what they're talking about. Because a lot of YouTubers make money through appealing to 8-year-old kids. Because you have to remember that the YouTube, the whole market is just for kids. So guys like me who will push technical jargon will not be appealing, right? So if you want to make a lot of money, if they are serving algorithm, which is appealing to 8-year-old kids, they do not know what they're talking about, but they can make it sound interesting. So that's why YouTube exists. You see, become a millionaire. You can. Why would you buy one Apple stock if you can buy 3 for the price of 1? Oh my God. And out of generosity of their heart, Mr. John Steinberg, who is 34 years old and earns $7 million per year, is going to hand you over 2 Apple stocks or 2 Nvidia stocks or Amazon stock out of generosity of their heart. Now, you have to remember, the wealthy never, ever take the risks. The wealthy do not take the risk. The wealthy offload the risk to the middle class, paying themselves fat salaries, right? Paying themselves stock options, right? Which they sell. They do not buy the stocks themselves. They issue the stock themselves to themselves, right? And then they sell it to you. Do you understand? Guys like this, I'm talking about like the small companies, right? That's the way they make money. They make money through salaries, bonuses, and by issuing the stock that they then sell to you. They do not buy their own stock. And you think that out of kindness of their heart, they are going to just hand you over stocks for free. It's complete bullshit. If you want to watch kind of the mentality of the Wall Street people, watch The Big Short and also watch The Margin Call. This movie here, Margin Call. Yeah, this movie here. Now, you get basically how the Wall Street guys who make like billions and billions, how they think. The first thing they do is you will notice that they never cut their own salaries. They never sell their own property. What they do is they fire employees and then break the contracts because they have some kind of fine print somewhere which allows them to break the contract. If you just watch The Margin Call, just watch how the wealthy, what do they do when the shit hits the fan. Do you understand? And then compare that to this explanation, and you will see that it just doesn't add up, because the wealthy do not behave like that. The wealthy will not wait 4 years, absorb all the risk, be in negative losses for 4 years so that they can in 4 years make some money out of your fund. Hopefully you're gonna stay in there. They do not do that. They do not do that. They will always offload the risk on you, right? So you have to remember, how do they offload the risk on you? And that is because they use your money to gamble, basically speaking, right? If you think about this, synthetic replication, they don't hold any assets whatsoever. They enter into swap agreements, which are, I already explained, effectively is a bet. You're basically betting, and that's it. All right? That's why, for example, if you look at the double or triple leverage S&P funds, they don't pay any dividends, right? Because the actual S&P fund, if you go to actual S&P fund, you look at distribution. Where is our distribution? Yeah, you see, they pay dividends every quarter, right? But if you're holding the leverage fund, there are no dividends whatsoever. So I was wondering, like, where is the dividends coming from? There is no dividends because they don't hold the actual asset. They don't hold the stocks. All they're holding is swaps, which is just a risky BS. Now, I hope you heard me there. All right. So the key takeaways: every time you invest into something, two things to remember. Number one, are they regulated? Right? Is the fund, whatever, is the company regulated? Preferably, you want to ask also, who is the auditor? Right? Is it some kind of reputable company, or is it some kind of Mr. Joe from somewhere, some kind of basement, and he says their accounts actually make sense? If you see that happening, that's a red flag immediately, right? So regulated, audited, and number three, if it's a fund, do they have physical exposure? If they have no physical exposure, do not invest into it, right? Now, Ponzi schemes always look like this: no regulation, no auditing, right? And wording is usually very vague, right? Somewhere we are, going to provide collateral, and maybe we're going to sell something somewhere. If you see shit like this, not regulated, weird language, and no auditors, never ever give them a single cent, because it's probably some kind of financial scheme designed for the wealthy to take your money. And that's it. All right? Take care.